Why do SMEs need capital? Typically, it's to finance working capital, to invest in technology, new infrastructure, to grow and enhance your sales and marketing, your management team, and to make strategic acquisitions. So generally, to continue to grow the business, it takes capital. And as Mariam already touched on, some of the sources of capital for these SMEs are, angels, venture capital, the banks, pseudo-financial institutions, private investors, and the JSE. Now, these are just some more personal thoughts on capital raising. So as a smaller business, I think that your viewpoint on capital and accepting capital or looking to raise capital is a little different than other businesses that are on different stages. So the first thing is that the capital needs to be more long-term based, because you're in an you're in the early stages of your business life cycle. And so you don't want to be in a situation where you're taking capital today and the person is expecting you to return the capital in 6 months or a year, because clearly your business is not going to grow to the scale that you want to be returning that capital in 6 months or a year. So it needs to be long-term based. It needs not to be restrictive. As entrepreneurs in the early stage of your businesses, you need flexibility. Today we think that we're going to be a, what was the example that you used? The chauffeur service, and then it may evolve into a taxi service, and it may evolve into a courier company. And so if you're too restrictive early, it hurts your ability to evolve and grow as a business. One thing that we've always tried to stick to is to find strategic capital, or what we call smart capital. Where you're not just taking money, but with that money comes, advice, or people with experience, or people with relationship. So you're getting something more than just the capital. You're getting something that's going to help to enhance your business. One of the downfalls we see in the market a lot, especially in the emerging markets where capital is hard to get, is where people don't raise enough capital. So they think, all right, I feel like I can get $1 million from people. I know I really need 5 to last me for 3 years, but it's going to be too hard for me to get 5, so let me go and get $1 million. And the reality is that capital raising, if you're an entrepreneur, is a distraction. It's taking away from the time that you need to spend to grow your business, to focus on your strategy, to focus on building your relationships, and so on. And so if you can do it less, it's better. So as much as you can raise to suit the needs that you have is better. But as Miriam said, there's an other side to that, which is that it must have specific allocations. So you don't want to just go and raise a ton of money and have it sitting there and not know how to allocate it, because no matter how good we think we are, bad habits will kick in, and if you have excess capital, you will start making bad business decisions. And it's also, as Miriam said, you can't go to her and not know where you're placing the capital. It should encourage proper governance. When a business is small, one entrepreneur, 2 partners or whatever, there's very little governance. It's just you guys arguing over stuff and coming out to the result. But as you look to grow, you need to position yourself to be able to take capital, and so your first time you do it, it should put some structure in place so that you have the governance to continue to grow under the right methodology that allows you to take capital as you grow. And then it must be at the appropriate valuation, and that's a given, right? You don't want to give away your business, as Mariam said, and you don't want a situation where you feel that you were gouged and there's just the partnership is not on the right footing or basis when you're starting out. What are the current challenges? In the Jamaican environment, there really is very little investing culture. You don't see this robust environment of private investors investing in private companies, and even on the public side, it's still limited. The economy, however, is the economy has made investors risk averse, and I'm going to talk about that and how that's changing over recently. But there's been a lot of cyclicality, a lot of changes in our economy, and so a lot of investors have been burned, and so it has created a very risk averse culture. There is no formal venture capital, but that's being developed now, so we're glad to see that. Those that do have capital tend to acquire late-stage companies with proven cash flow. You don't see a lot of people, going in and investing in smaller, newer, younger companies, and so we're hoping that changes. The banks are a challenge because of the BOJ regulations. A lot of them can't do, what we need as entrepreneurs, which is to lend unsecured. Because you start your business, you don't have a ton of assets, and so you don't have a lot of collateral, so you need flexibility, and that's just not there. What are the current opportunities? I think with what we've seen with JDX and NDX and the decrease in interest rates, there is more of an appetite to invest now outside of the traditional GOJ and traditional areas. So we're seeing that. We're seeing bank financing now becoming more reasonable. I don't know, those of you who have businesses, you may be getting calls more from the bankers than you used to, and that's a good sign. I think the junior market has done a great job in creating awareness. The government is changing regulations around and working toward changing regulations around pension funds, being able to invest and so on. So, releasing capital that we as entrepreneurs need. You're seeing pool funds and pseudo PE funds pop up. So, 3-4 wealthy families now are putting money together and say, hey, let's try and do stuff outside of our core businesses. And then we know what the DBJ is doing. And a shameless plug, we have our fund, our VC fund that we've now done with NCB. It's a start at $50 million, and we're going to be investing about 2 to 3 companies. And we have a pipeline of $500 million that will be open if we're successful with the first 2 or 3 companies. What can you do to make yourself ready for investment? And I'm going to fly through this really quickly, but the first thing is, you need to build your company for investment because you need capital to grow, and if you don't start now, then by the time you need the capital, it'll be too late. So keep proper numbers. I can't tell you how many times we've done 15 deals, we've probably looked at 40. And I can't tell you how many times we've seen really good businesses, good business models, but when we dig in, everything is kept in a full, some papers, and I mean, it's tough for us to verify that, so it's tough for us to invest. Put proper governance in place. Again, most Jamaican businesses that have grown, family businesses or individuals, don't have the proper governance structure, and so it makes it difficult for an investor to step in. Build and maintain your business plan. I think Miriam killed that point, so we don't need to go over that again. Maintain communication with the investors. It's important that people know your story before you need capital. People see your growth, people understand what you've been doing. Just like anything else in life, if somebody comes up to you and says, hey, I'm great, and they're telling you that for the first time, you're a little cautious. But if over a 3-4 year period, they said, hey, I did this, oh, and then I just did this, and you understand and can see the growth of that person, and when they actually need the money, you're more apt to invest with them. So keep communication with investors, let your story be known, and build your network. And then work with the customers and suppliers, because it's important. It's funny how your customers and suppliers are very likely in many occasions to become your investors, your supporters, and so make sure that we maintain relationships there. What are some of the pitfalls that we see? Don't get caught up on percentages. I can't tell you how many times people have said to us, oh no, 70% or 20% is way too big. And they have no basis. I mean, 20% of what, and so don't get caught up on percentages, but get caught up on value. I think Mr. Rain said it best when he said a slice of a watermelon is bigger than the grape. Maintain operational control. This speaks to young companies. I think that it's important, especially in a Jamaican environment, that you stay at the helm and continue to grow your business. It's tough to find. And this may sound strange, but in Jamaica, it's tough to find management that will grow and push your business as much as you will as an entrepreneur. And so, depending on what the investor wants to do or what they're coming in with, I think it's important that you still maintain control and drive the impact of your business. Make your investors your partners. It's not passive capital. Involve them, make them aware of things that are happening in the business. There's a reason why they're investors, because they've done well somewhere else to get capital, right? So they may be able to help you to build a relationship, to open a door, to think through a problem, And that's one of the things that, you know, we see pitfalls in this process, is that people take the money and then they kind of go back and hide and continue doing what they're doing, and they have this great person with a vested interest in their business that they can use to help. Earning structures is just, you know, an ability for you to earn back your business, right? So let's say you gave up 50% of your business because you needed the capital, but you truly believe in your talent. Well, try to put a structure in there that if you blow it out of the park and you do really well, that you can actually get back some of what you gave up and still leave, you know, some good return on the table for the investors. And then manage the risk of your investors. You know, it's already a tough environment to raise capital, so if you can make their risk appetite, or sorry, if you can manage their risk or lower their risk by giving them some kind of preference or something, it makes it easier. So what we mean by that is that they get the first money off the table. If they give you $100 and over time you've pulled out dividends or whatever, give them back their $100 first, you know, and that makes it easier for them to invest. And I already did this shameless plug, so I won't talk about Katalyxt again, but you know, you will be hearing about it in a couple weeks, and we are looking for businesses. So again, if you have a business and you're looking for investment, you know, this is a live, not developing, this is going to be a live active fund that's going to be investing in small businesses.